Hey traders! In today's video, we're diving into one of the most powerful concepts in ICT. The theory of premium and discount. As traders, our main job is to figure out when to buy and when to sell. Understanding premium and discount levels can give us a serious edge. In this video, we'll break down what these zones mean, how to spot them, and most importantly, how to use them to refine your entries and exits for better, more profitable trades. So if you're ready to take your trading decisions to the next level, stay tuned, let's get into it. The market usually moves in two types of waves, impulsive and corrective. This repeating pattern happens because of how traders behave depending on how they feel about the market. When people are feeling positive and confident about a currency pair, they start buying. This buying pressure pushes the price up strongly in what's called an impulsive move. But as the price keeps rising, some traders think it's getting too expensive and decide to take their profits. Others might even sell, expecting a drop. This can lead to a pullback or a small correction. Now on the flip side, when traders are feeling negative and not so confident, they usually start selling, which makes the price fall fast, another impulsive move, just in the opposite direction. As the price drops, some traders feel it's gone too low and start buying again, which can cause a bounce or retracement. Impulsive waves usually move the price more and come with strong momentum. You'll often see big candles that are all the same color. Corrective waves, on the other hand, are more like pauses. They show indecision and are made up of smaller, mixed-color candles with wicks pointing sideways. If you can spot when a correction is ending and a new impulsive wave is starting, it can be a great chance to jump in and catch a strong move in the market. Imagine we're in a downtrend and we want to sell when the price is high and buy when it's low. To make the most of this bear market, we can't just sell right now because the price is already low and might go up at any moment. So, we need to wait for a pullback to get in at a better price. The last big drop started here and pushed the price all the way down to here. Any correction will probably happen within this range. Once the market gathers enough liquidity and more sellers jump in, the price will likely keep going lower. But, if the price breaks above this level, it means the sellers have lost control. This would question the whole idea of the downtrend. It could show strong buying pressure and hint at a potential reversal unless it's just a fake-out, where the market pushes above this high to trap buyers, collect liquidity, and then drop again. Now the big question is, where should we actually open our sell position and jump into the market? Okay, if we enter too soon, the price might pull back even more, and we could take a loss, even if our overall idea was right. But if we wait too long, the price might take off without us and we miss the opportunity altogether. That's why trading with the main trend is really about spotting the end of the correction. That's usually when the next strong move begins. But how do we figure out exactly where that point is? This is where discount and premium levels can help us out. We use Fibonacci by drawing it from the start of the big move to the end. It helps us see where the pullback might happen. We're only looking at the 50% level. The upper 50% is called premium. The lower 50% is called discount. That 50% line in the middle is called the equilibrium. When the market is going down and we're in a downtrend, we want to sell in the premium zone. Why? There are two simple reasons. Reason number one, better risk to reward ratio. No matter where we enter, our first target is usually the last high in the trend. When the price hits that level, some traders take profits, others might buy more, and that can cause a pullback or even a reversal. So that level is where we want to aim first. Now, if we enter the trade from the premium zone, we're getting in at a lower price, so our risk is smaller and our reward is bigger. That gives us a much better risk to reward ratio. Ideally more than 1-to-1. That's why it makes sense to sell in the premium zone. It gives us smarter, safer trades with better potential profits. Number 2. It gives us a safer entry. The market often goes down first to trap early buyers, then goes up. So if we wait for the price to drop into the discount area and then look to buy, we'll have a better chance of winning. Of course, no plan is perfect. Sometimes we might miss a trade because we're being careful. But missing a trade is way better than losing one. Alright, let's do a quick recap. But this time in an uptrend. Imagine the market is going up, and we want to sell high and buy low. To make money in this kind of market, we don't want to buy right away, because the price is already high. We should wait for a pullback, so we can enter at a better price. The last big uptrend started from here and went all the way up to here. Now we expect a correction to happen somewhere in this range. Once the market gathers enough liquidity and buyers jump in, the price will likely keep going lower. Then the market will likely keep pushing lower. So, we'll use the Fibonacci retracement tool again to mark out the premium and discount zones. When the market is bullish and we're in an uptrend, we want to buy in the discount zone. That's where the price is lower and gives us a better entry. Here's something important to remember. Impulsive moves can happen on a bigger scale too. For example, let's say we're looking at the 1-hour chart. We might see 3 separate moves. An uptrend, then a downtrend, then another uptrend. But if we zoom out and look at the higher time frame, all of those moves might just be part of one big move. So if we use the Fibonacci tool on that larger impulsive wave, it'll give us new premium and discount zones. That means there's a higher chance the price will go into the discount zone, and then we might see a reversal from there. Now let's talk about how to mix this with smart money concepts. Think of this setup as our higher time frame structure. When we see a change of character on a lower time frame, it can be a sign that a reversal might happen soon. If there's enough liquidity and the market shows bullish momentum, the price will likely start moving upward. But if there's not enough strength, the price might just keep falling. This kind of setup can repeat a few times before the market finally gathers enough liquidity and momentum. And when it does, the price usually takes off and gives us that big move we've been waiting for. Instead of jumping in early, we wait for a change of character to happen inside the discount zone. That gives us better confirmation. Another confirmation are FVG. In this example, we can see 3 FVGs on the left side. When the price comes back to those areas, they can act like support and push the price up. But we only want to buy in the discount zone. So we would choose the lower 2 FVGs, not the one that's up in the premium zone. This kind of trading is more careful, and it usually gives us a better risk to reward ratio. It works best when the market pulls back deeply. But if the market is moving fast and strong, buying in the premium zone can still work sometimes. Now, here's something important. You won't win every trade, even if you only take high-quality setups. The market doesn't always follow our plan. But even with just a 30% win rate, you can still make money, if your risk management is solid. You can't control one single trade, but with a good plan and good discipline, you can do well over time. So, always take high-quality setups, follow your rules, and most importantly test your strategy on past data, backtesting, before trading with real money. That way, you build confidence and understand how your system really works. Now, let's check out a real chart example. We're looking at the euro on the 4-hour chart. It's clearly in an uptrend, and this is our latest bullish impulsive wave. Let's use the Fibonacci retracement tool to find the premium and discount zones for this wave. Now let's see if we have any FVG and an ideal trade setup. Looking at the left side of the chart, we can see a FVG between the candles. We'll mark this FVG. This area becomes our optimal trading zone, which is sitting in the discount area of the range. Here's the plan. Wait for the price to move into that zone. Once it's there, zoom in to a lower time frame, like the 1-hour chart. Look for a change of character to confirm the reversal. Then take the buy trade. If you want more tips like this, make sure to backtest your strategy, follow your rules, and practice with a plan. Thanks for watching.